In 1983, inside a coffee shop in Hattiesburg, Mississippi, two men drafted a business plan on a napkin. The entire corporate structure relied on an uninterrupted cycle of aggressive expansion. In early 2000, that cycle broke. Sullivan's biggest problem was line costs. Whenever WorldCom routed a customer's call through another company's network, they had to pay a rental fee.
By illegally mislabeling their biggest expense, WorldCom fabricated billions of dollars in fake profits, keeping the stock high and protecting Ebbers from his creditors.
When confronted with this paper trail, Ebbers stuck to a repetitive defense. When asked about the missing hundreds of millions, she had tried to resign multiple times when asked to alter the books, but Sullivan convinced her to stay. The abstract numbers in the courtroom masked an immediate human tragedy. 17,000 people lost jobs in a single stroke. In 1983, inside a coffee shop in Hattiesburg, Mississippi, two men drafted a business plan on a napkin. The idea was straightforward: buy long-distance phone minutes in bulk and resell them at a discount. That napkin sketch was the foundation of LDDS, a company led by a former basketball coach and motel owner named Bernie Ebbers. Ebbers grew the business using a relentless strategy. He used debt and his own company's rising stock price to acquire over 60 different telecom firms in the ensuing decades. By 1998, LDDS had changed its name to WorldCom and executed a $36.5 billion buyout of MCI. WorldCom now controlled a quarter of the U.S. internet backbone, routing half of all emails worldwide. WorldCom required constant acquisitions to survive. When they bought a new company, their stock price would climb, giving them capital for the next. The entire corporate structure relied on an uninterrupted cycle of aggressive expansion. In early 2000, that cycle broke. The dot-com bubble burst, leaving WorldCom with thousands of failing tech clients unable to pay their bills. To make matters worse, U.S. and European regulators blocked WorldCom's next major lifeline, a $115 billion merger with Sprint. Ebbers was completely exposed. Over the years, he had borrowed more than $400 million to buy personal assets like vast timberlands, a yacht-building company, and a sprawling ranch. To secure those loans, he had used his personal shares of WorldCom stock as collateral. This graph illustrates the exact mechanics of Ebbers' margin call. If WorldCom's stock price dropped below $12 a share, the banks would demand immediate repayment. To keep the stock price above that $12 threshold, WorldCom needed to hit Wall Street's expectations. Since his personal assets were tied up in real estate and boats, a drop in the stock price meant total financial ruin for the CEO. But internally, the shrinking market meant the company was missing its revenue targets and losing money. The CEO's personal wealth now required the company's stock to stay high, while the company's actual ledgers showed a severe downturn. Ebbers needed a way to make those internal mosses disappear. The person responsible for the company's math was Chief Financial Officer Scott Sullivan. Highly decorated in the finance world, Sullivan was tasked with bridging the gap between WorldCom's failing reality and the soaring expectations of investors. Sullivan's biggest problem was line costs. Whenever WorldCom routed a customer's call through another company's network, they had to pay a rental fee. These fees were enormous, sometimes reaching $1 billion every single month. This flowchart demonstrates the core accounting trick used to hide the losses. In corporate accounting, standard daily bills like these, line costs, are recorded as operating expenses, which subtract directly from a company's immediate profit. But long-term investments, like building a new facility, are treated as capital expenditures. Because capital expenditures create an asset, the cost is spread out over many years, keeping the current year's profit intact. Sullivan instructed his team to take those massive daily line costs and simply recategorize them as capital expenditures. By moving the numbers from one column to another, $1 billion in pure expenses suddenly became $1 billion in long-term corporate assets.
By illegally mislabeling their biggest expense, WorldCom fabricated billions of dollars in fake profits, keeping the stock high and protecting Ebbers from his creditors. To keep track of the lie, Sullivan maintained two separate sets of books. One spreadsheet showed the normalized, accurate expenses, while the final version contained the heavily manipulated numbers prepared specifically for Wall Street. Implementing this required help. Mid-level accountants were repeatedly ordered to make fraudulent entries. When they drafted resignation letters in protest, Sullivan personally pressured them into staying and executing the changes. Not everyone stayed quiet. In late 2000, a financial analyst named Kim Emi recognized the unusual accounting directives as blatant tax fraud. He reported it to his superiors. By March of 2001, Emi was fired. WorldCom's upper management created an environment where raising concerns resulted in termination, forcing employees to choose between their livelihoods and their ethics. In May of 2002, Vice President of Internal Audit Cynthia Cooper noticed an unusual phrase in the company's financial system, prepaid capacity. When she asked the corporate finance director to explain the term, he couldn't provide an answer. Company executives pushed back against her inquiries, calling her audit a waste of time and asking her to delay her work. Suspecting they were being watched, Cooper and her team began running their server searches in the dead of night, extracting data while the office was empty so they wouldn't trigger any unusual activity alerts. In the dark, they found the proof. Millions of dollars were being systematically stripped out of the income statement and dumped onto the balance sheet. They uncovered an unbroken chain of unjustified transfers stretching back over a year. The executives had spent years intimidating accountants and hiding their tracks. But Cooper's commitment to basic arithmetic dismantled the entire operation in a matter of weeks. On June 17th, Cooper presented her findings to the board's audit committee. Within days, Sullivan was fired. WorldCom then made a public announcement, admitting to $3.8 billion in accounting misstatements, a number that investigators would later revise to over $11 billion. The market reaction was instantaneous. WorldCom's stock, which had once traded at $64, fell to just 6 cents a share. A month later, carrying $41 billion in debt, the company filed for Chapter 11 bankruptcy. 17,000 employees lost their jobs almost overnight. Because many workers had their retirement accounts tied up in company stock, the collapse vaporized the life savings of hundreds of thousands of people. That July, Bernie Ebbers was subpoenaed by a congressional committee. Sitting in front of the cameras, he read a prepared statement declaring his total innocence. Then, the moment lawmakers actually asked him a question, he invoked his Fifth Amendment right and refused to speak. The executives responsible for the manipulation spent years shielding themselves from reality. But when the numbers finally caught up to them, it was the employees, the investors.
By March 2005, the bill for an $11 billion lie had finally come due. Inside a New York courtroom, former CEO Bernie Ebbers faced trial for the accounting fraud that brought down WorldCom. The prosecution brought out their star witness, Scott Sullivan, WorldCom's former chief financial officer. Sullivan had already pleaded guilty to securities fraud and conspiracy, agreeing to testify against his former boss in exchange for a lighter sentence. On the stand, Sullivan testified that every time WorldCom's quarterly results fell short of Wall Street's expectations, Ebbers would personally order him to fix the numbers. Sullivan made it clear that Ebbers knew exactly what he was doing when they hit the company's expenses. The prosecution backed this testimony with physical evidence, a doctored budget report from September 2000. It showed line cost expenses at just $732 million, hiding the reality that the actual costs were $1.4 billion. Right at the bottom of the document was Bernie Ebbers' signature. When confronted with this paper trail, Ebbers stuck to a repetitive defense. When asked about the missing hundreds of millions, he told the court, "I just didn't see." He claimed finance was Sullivan's territory, painting himself as an executive who was entirely out of the loop. The jury rejected the claim. On March 15th, they handed down their verdict, finding Ebbers guilty on all 9 charges of securities fraud, conspiracy, and making false filings. 4 months later, the judge delivered a 25-year prison sentence. For a 63-year-old man, it was effectively a life term. The ensuing settlements stripped Ebbers of his home, his lumber company, his golf course, and thousands of acres of land. A clear legal boundary had been drawn. A chief executive could no longer sign off on doctored ledgers and successfully hide behind a claim of willful ignorance. The legal reckoning quickly worked its way down the corporate ladder. CFO Scott Sullivan received a 5-year prison sentence, while the Director of General Accounting and the company controller each received shorter sentences of a year and a day. Then there were the mid-level accountants, people like Betty Zinsent. She had tried to resign multiple times when asked to alter the books, but Sullivan convinced her to stay. Her compliance kept the fraud alive, earning her a guilty plea and a sentence of probation. But the internal employees weren't the only ones checking the math. WorldCom's external auditor was Arthur Anderson. the same firm that missed the massive fraud at Enron. They had certified WorldCom's accounts as clean, ignoring glaring red flags in the ledger. The financial penalties outside of criminal court were staggering. Citigroup eventually paid $2.65 billion to WorldCom investors, while Ebbers and his co-defendants paid out over $6.13 billion in civil settlements. Hiding $11 billion requires a chain of complicity. It stretches from coerced accountants in cubicles all the way to billion-dollar independent watchdogs who failed to raise the alarm. This chart tracks WorldCom's market cap, peaking at $180 billion before fraud forced bankruptcy. At the bottom, 800 KPMG and Deloitte auditors untangled the ledger. By 2006, Verizon acquired the renamed MCI for $8.4 billion. The WorldCom brand was officially erased. A corporate empire that ignores its core business to focus solely on aggressive acquisitions and phantom accounting inevitably writes itself out of history. The abstract numbers in the courtroom masked an immediate human tragedy. 17,000 people lost jobs in a single stroke. Many of those employees had tied their retirement savings to WorldCom stock, watching shares that once traded at $64 evaporate to just 6 cents. The collapse was especially devastating for Clinton, Mississippi. WorldCom was the only Fortune 500 company in one of America's poorest states. When the fraud broke, it destroyed the primary economic engine of an entire community. The blast radius extended far beyond Mississippi. WorldCom's fictitious profitability created a dangerous illusion of growth. Equipment suppliers like Lucent Technologies, Nortel Networks, and Corning built huge inventories for this phantom demand, leading to massive layoffs across the telecom sector. Even industry giants took heavy collateral damage. AT&T spent years exhausting its resources trying to match WorldCom's impossible margins, weakening the company so severely that it was eventually acquired by SBC Communications. The falsification of a single line item on a spreadsheet carries a heavy human price, destroying working-class livelihoods and destabilizing entire global industries. The sheer scale of the destruction forced Washington to intervene. In July 2002, the U.S. Congress passed the Sarbanes-Oxley Act, enforcing strict new regulations. Under the new law, executives can no longer claim they were out of the loop. CEOs and CFOs are now required to personally certify that their financial statements are accurate, facing direct criminal liability if they sign off on a lie. The legislation also introduced Section 404, mandating strict internal reporting controls. This specific provision was included because whistleblower Cynthia Cooper fought to audit the company's nighttime ledgers despite executive pressure to stop. Cooper's persistence earned her recognition as Time magazine's Person of the Year. Her actions proved that internal controls are only as strong as the people who have the courage to enforce them. Her legacy stands in stark contrast to Bernie Ebbers. In December 2019, a federal judge granted him early release from prison due to declining health. He died 2 months later at the age of 78, maintaining until his final breath that he had never committed fraud. Unchecked greed in personal debt dismantled a $180 billion empire. But the fallout from WorldCom highlights the power of internal oversight. By looking at the true numbers when others refuse to, Cynthia Cooper provided the catalyst for the reforms that now govern